Thank you all for joining us for the sixth of our COVID-19 business continuity planning webinars here at MHA McIntyre Hudson. Certainly a lot's happened over the last few weeks, and lots of advice has been given and taken in relation to business continuity planning. We're still in those throes, although we're moving obviously quite rapidly through to the next phase and recovery. I'm really pleased to be joined today by Greg Taylor, our partner in MHA Financial Services, Jay Batty, our Research and Development Tax Specialist, Patrick King, who's a tax partner and head of our MHA National Association Tax Group, and Alison Horner, our VAT partner. And we're just going to run through an update and some planning points in relation to the Coronavirus Job Retention Scheme, CBILS and other financing, research and development, IHT capital planning, VAT and PAYE deferrals, and Alison's going to touch on that lovely Brexit, which we mustn't forget about. So, just to start off on the Coronavirus Job Retention Scheme, since our last webinar, obviously quite a lot has happened. We knew there was an announcement coming. We knew we'd get some updates. We indeed did at the end of May, and then some further promised updates that we received on the 12th of June. Which they said that they would. They didn't tell me at the time that it was going to be 9 o'clock at night when they would send that through on a Friday evening, but there you go. We're used to sort of updates from the government on Fridays and Saturdays through the crisis. So just to give you an update on the Coronavirus Job Retention Scheme, as of the 14th of June, this has now supported 9.1 million jobs at 1.1 million employers. So that's kind of been levelling out over the last few weeks, and it's now funding £20.8 billion. So that's well on track by the time the scheme ends, which will be the 31st of October, for maybe close to 40 to 50 billion pounds having been provided through this Coronavirus Job Retention Scheme. So a very, very significant scheme, talked about all of the time. But of course it is closing, and it closes has already closed to all employees who haven't already been furloughed. So if you haven't had somebody had their 3-week consecutive weeks of furlough between the 1st of March and the 30th of June, then they won't be able to participate in a grant claim in the period up to the end of October. So for some people, as I say, the scheme is perhaps already closed, but it is carrying on until the end of October. And if somebody starts a furlough period before the 1st of July, they need to get their minimum of 3 consecutive weeks in. So whilst from the 1st of July we move to our flexible furlough arrangement, and we can perhaps look at furloughing people part-time and on a week-by-week basis, we need to get those 3 consecutive week blocks in. So if somebody started a furlough period on the 22nd of June, so assuming that they'd been furloughed at some point for 3 weeks between the 1st of March and the 30th of June, they started another period on the 22nd of June, they can't come off furlough and go on to flexible furloughing until after the 12th of July, until after that next 3-week period. So just something to be mindful of if you've kind of got people currently furloughed. When they move on to flexible furlough would depend upon when they get their 21 consecutive days in. So the rules are changing from the 1st of July with that flexibility, as I mentioned. You can bring people back to work part-time for any amount of time, for any shift pattern, and make a claim for the normal hours that they're not working. So you need to report and claim for a minimum period of a week. So your claim period can't be for less than a week. And then you will need to submit some extra details. So you'll need to start recording data on their usual hours. They usually work in a pay period, and what are the actual hours they're working in that pay period or claim period. So some simplicity in the scheme, or flexibility in the scheme moving forward, but actually a bit more complexity in terms of the record keeping that's required. And when you make a future claim under the flexible furlough scheme, so from a period after the 1st of July, you won't be able to claim for any more employees in that claim period than have been included in a previous claim period. So if you had, for sake of argument, 30 employees on your claim in April and 20 employees on your claim in May and 15 employees on your claim in June, then in July you won't be able to make a claim for more than 30 employees. That was the maximum number of people you had in any claim that you've previously made. And with the scheme as it currently is up to the end of June, you must make all of your claims. So for any period from the 1st of March up to the 30th of June, and of course you can't overlap dates. You're not tied to making claims on any particular claim or pay period, but all of the period from the 1st of March up to the end of June has to be made and in by the 31st of July. So you can't come to the 1st of August and think, oh crikey, I haven't put my claim in yet for that week in June. You won't be able to. And then going forward, every month, you'll need to put a claim in only for that month. So 1st of July to the end of July, 1st of August to the end of August, September to the end of September, 1st of October to the end of October. It'll just be for those months. So there'll be no overlapping of pay periods or claim periods within calendar months, as there has been the ability to from March to the end of June. So a bit more strictness in terms of the dates that you can include in your claims going forward, the number of people you can claim for, and obviously the record keeping that you need to provide. And of course, as we move to flexible furlough, you will also need to relook at your furlough agreements with your employees, because you may well have an agreement that has an end date or relates to the fact that whilst they're furloughed, they can't work for you at all, which was obviously the requirement up to the end of June. But from the 1st of July, of course, those periods will vary, and they won't need to be furloughed for 21 consecutive days anymore. So you'll need to think about new agreements, keeping those agreements and keeping all those records and consultation, documentation and emails and what have you in place for 6 years. And obviously the number of hours, keeping a record of detailed record of the number of hours people are working or are furloughed. You can only obviously claim for a period of less than 7 days if that period includes either the first or the last day of the calendar month, and you've already claimed for a period ending immediately before it. So of course there may be times when you're looking at a claim period and that might be less than 7 days. That will be okay, but providing that's just bringing the month up, closing the month off in relation to your claim period. And so we're really now looking at not only previous pay, but also previous hours, because obviously as somebody is furloughed, that furlough pay continues to be calculated based on the previous year's pay. So that pay prior to the 19th of March 2020, that will still be the basis for the furloughed pay. But of course, as you bring somebody back, if they come back to work for you for say 2 days a week and they're furloughed for 3 days a week, then those 2 days have to be paid at their current rate of pay. So if there was an incremental increase that kicked in from the 1st of April, or the national minimum wage or living wage increase, so you're going to have very different bases of pay to go through the payroll, because obviously the payroll will need legally to be at the current rate, but your furlough pay and your furlough claim is still at that previous rate. So again, a bit more complexity that's going to kick in. And therefore, what HMRC are looking for you to do is make sure that you've got certainty over the exact number of hours or days that people are going to work and that are going to be in your claim period before putting that claim in. Obviously, they're still committed to making those payments to you within 6 days. So clearly, whilst you still have the opportunity to put a claim in 14 days before the end of that claim period, it's the ideal is to have certainty on the hours that people are going to be working and that you're going to be furloughing them for and claiming for. And so you may sort of put that claim off until a bit closer to the 6 days before the end of the month, just so that those claims are correct. because there's a real focus emerging quite heavily from HMRC in relation to compliance and getting it right. There's obviously the opportunity for you to amend future claims where you've overclaimed in the past, but there isn't yet a process for you to put to amend future claims where you've underclaimed in the past. So they're kind of still working on that, or working on the fact that if you don't have any further claims to make and you find that you've overpaid, they're looking at that process as well. But they're certainly very focused on the scheme having been operated properly, the amounts being calculated correctly, and that's been a feat in itself, and for things to be correct, and then really to clamp down and claw back as quickly as possible any overpayments where people have got things wrong, and particularly if they've got things wrong deliberately, or not paid the right amount to employees, then there are some fairly draconian penalties going to be applied. But as I say, the aim is to get everything up to the period ending 30th of June in by the end of July, after which time, again, you may be in the realms of recovery proceedings rather than making amendments to future claims, and therefore potential interest and penalties may start to apply. So really important to get your house in order and keep on top of that on a month-by-month basis as we go through flexible furloughing arrangement. Clearly, the amounts are going to change as well. So the 80% still remains. If somebody's furloughed, they will still be entitled to that 80%, capped at £2,500 a month. The government will support the funding as it is to the end of July. Then for August, they'll support the pay, but not the national insurance and pension. Then from the 1st of September, they will support 70% of the pay. So you'll have to include a 10% mandatory top-up from the employer, and they obviously won't pay any of the national insurance or pension anymore. And in October, it'll be a 20% mandatory top-up from the employer, as well as paying all of the national insurance and the pension. So some things are changing in terms of the quantum of the funding, the records you're required to keep, the complexity involved, and HMRC are making it very clear that they will not hesitate to take action against those found to be abusing the scheme. So a bit of a health warning there in relation to the changes. So a lot there, a lot changing, a lot going on. Obviously, lots of updates from ourselves as normal, and some more detail of this will be published on our website. So everything I've just covered will be on our website later on today as well. So you haven't got to remember everything that I've just been through, as there's quite a lot there, as we know. So that's on the job retention scheme. So going well. Still lots of support there. Still a phenomenally successful scheme, meeting the aims that the government wanted, but obviously lots of nervousness over the ability to fund it at the current levels, which kind of just isn't sustainable, and ensuring that there isn't fraud or errors in there. And so, the government are looking at seeing how they regularise that and claw back any monies that are due. So make sure you're on top of it all. So that's it for me on the job retention scheme, and I'll hand over to Greg Taylor now to cover some of the other sort of financial support elements and top tips. Thank you.
Good afternoon, everybody. So a couple of bits I want to cover. So I think in the first instance, let's look at the coronavirus business interruption loan scheme. So the three that are available there. And then I want to talk about funding a business post-COVID as we enter that post-COVID phase, and some of the things that we're seeing and some tips around that. So particularly on the coronavirus business loan interruption scheme, the original scheme, the details as of the 14th of June were that the value of facilities approved now stands at 10.11 billion. Number of facilities approved, 49,247. And total number of applicants, which is an interesting one, I'll come back to that in a second, 96,492. Now, when you consider that the total number of applicants is 96, let's call it 96,500, and the total number of businesses in that particular sector that could have applied, so those businesses in that turnover range up to 45 million, 46 million that could have applied is 770,000 SME businesses that could have applied, and there's only been 96,000 applications. I'll leave you to draw your own conclusions, but I wonder whether the economy and some of those SMEs are actually a little more resilient and a little more well prepared than perhaps we've been led to believe. On the larger business scheme, the total amount of cash out the door now is 1.77 billion. Total number of facilities approved, 279, and total number of applications as of the 14th of June, 661. Bounce back loan scheme, 14th of June, 26.34 billion. Number of facilities approved, 863,584, and total number of applicants just over 1 million. I would definitely say that the bounce back loan scheme out of the three schemes is certainly the star of the three, and certainly should have been the basis upon which certainly the original CBIL scheme was based, rather than the very elongated and cumbersome beast that it has become. The scheme is still open and will remain open. I expect a statement as part of the Chancellor's comment, which was going to be a budget, but is now only a comment or a moment now, when he speaks in early July, and that scheme will be revamped to help businesses with the next phase of post-lockdown and some further information around how you can borrow money with a government guarantee. So certainly there's been some really good individual performances from certainly from the high street banks. There's now 73 accredited members of that scheme. So there's lots of different variety to now choose from. But certainly a standout for me would be NatWest, who have lent twice as much as any of the other high street banks. And from our experience of dealing with them, really have tried to help clients where possible and to mould a deal that really, really works. Clearly, when Rishi Sunak stands up to give his moment, then he will be talking about whether there will be a recession or not. I'm sure that will be one of the comments that he will make. Fortunately, not all the financial experts share his pessimistic outlook. The Bank of England Governor Andrew Bailey said that his belief is that the economy will bounce back strongly after the end of the lockdown. And certainly that the lockdown measures are now being relaxed, as we will see, and the world seems to be keen to get back to work again, which is good. Of course, businesses everywhere may be slow initially as people deal with the financial shock of the lockdown and try to get their finances back in order again. Most business owners that we've spoken to are currently looking at the immediate needs of their business over the next 3 months rather than the future. However, the future is coming, and it is time to start looking at how your business will thrive in the new normal. There are a couple of steps that we'd like to talk to you about today around your business and getting it ready financially for the new normal. The first is dealing with the next few months and the ramp up to full trading when income may be slow in coming in and debts are building up during the lockdown will need to be paid. Things like the deferred VAT, the payment holidays on asset finance or loans, the furlough, as Nigel's just been speaking about, coming to an end, and other payments that as we get past this initial opening of the lockdown will suddenly need to be paid and may be long-standing. Cash flow forecasting, therefore, to ensure your business has sufficient working capital will be vital over the coming quarter. Planning in advance what borrowing you need will ensure you can look at the most appropriate form of finance and get the best rates. If you do need further finance, planned or unplanned, further working capital, there are a few things you should be aware of that we've seen in the market. More than ever, lenders are sector-driven. Those sectors like travel and tourism, for whom the lockdown is yet to really come to an end, are facing more scrutiny over their financials when they're looking to borrow and are, in the bank's views, less favoured than some other sectors like manufacturing, for example. Understanding a lender's appetite is really important, and there are many specialist lenders for individual sectors. Number 2, government business support schemes don't stop once if you've got a CBILS loan. As I've said previously, there are 73 now new accredited lenders on the scheme, including high street banks, but there are also many specialist lenders now dealing in asset finance, quite recently property as well, where CBILS can be taken advantage of in funding particular assets. And there are some really, really good deals. Invoice finance is another one, nothing to pay for the first 12 months on an invoice finance facility. Take advantage of those. Even if you have a CBILS facility, you can still look to put one of those alongside it, or even go back in for a top-up with a different funder. Funding post-COVID, at the moment, as the market settles down, almost always comes with personal guarantees or is secured on other business assets. If you have business assets are king at the moment. Assets are king. Lenders like assets. They like their finances secured at the moment in these very uncertain times. And you should be aware that if you're going for further funding, it will almost certainly involve either a personal guarantee or security on other business assets. Clearly demonstrating what the cash is being used for and affordability is becoming more important. We're seeing more and more lenders where you would normally take a term loan, or you're talking to a lender, whether it be a high street bank or a challenger bank, and you're saying, we need cash, or what do you need it for? It's just for working capital. You know, that is no longer a decent enough reason. They really want you to break that down for you to be clear as to where that cash is going to go. What's the benefit to the business? How is it going to move the business forward is a good phrase that we've heard quite often at the moment. And so to go with a clear plan and a clear cash flow is massively important. We've been doing this at MHAFS for a number of years now. And if you need any help with cash flow loans, we understand the market, and we're more than happy to give individual advice on an individual basis. The second area I'd like to look at is changes that might have been triggered by the crisis to help you take advantage of the crisis and realise that the world and your business are not going to be the same as the way they were. So, for example, if you're a retailer, you need to recognise that people will be less keen on physical shopping in the immediate future, and therefore more enthusiastic about deliveries, and therefore there's an advantage that you can take. Perhaps you're looking at adapting to remote working and it's worked really well, and you need to therefore perhaps invest in your IT network to get ahead of the competition. Again, at MHAFS, we're keen to try and help you find the most cost-effective ways to bring in the equipment and services that you need. Raising finance post-COVID will involve a lot of market research for SMEs, as there are many different sorts of lenders out in the marketplace in 2020, from challenger banks to fintech lenders, and also niche asset finance lenders dealing with individual markets and sectors. Knowing the market and having confidence about dealing with a lender whose name you may never have heard of can be daunting. Having a trusted specialist advisor has never been more important, especially when dealing with one of your business's key areas, working capital. After all, you are only as good as the people you work with. With that, I'll hand on to my colleague Laurence, who can give you some advice around corporate finance and how we can help.
Thank you, Greg. I'd like to spend some time now giving you a flavour of some of the key factors that you need to be thinking about if you're considering raising equity finance rather than the debt finance options that Greg's just run through. And I'll also provide some meat on the bone regarding the recently announced Future Fund. We're seeing a lot of interest from equity investors at the moment, so this is very much a topical subject. So firstly, some of the key considerations regarding equity finance. I'm going to run through about 7 or 8 of those now with you, just to give you a feel for the sort of things that you need to be thinking about. First one is the cost of the equity. Equity investors are very much at the bottom of the unsecured creditors list if a business runs into difficulty. So they're going to be expecting a higher return for the higher unsecured risk that they're taking when they invest. Over the lifetime of the investment, this return can be anything between 2.5 to 3 times their initial investment, which can equate to something like 20% plus return per annum. So obviously that's much higher than the cost of secured debt. Current debt levels in your business is also something that you'll need to consider. Existing financial covenants may restrict the raising of more debt. So equity may in fact be the only viable route available to you if you do wish to raise more funding. Also, the growth profile of your business. Businesses with higher growth prospects are far more attractive to equity investors, as they offer the best chance of the high returns that I mentioned a few moments ago. Future exit options also need to be considered. Equity investors ultimately want to realise their investments, so there needs at the very outset to be an alignment of thinking with you, the existing shareholder, on an exit strategy and timings with the new investor. The duration of the funding also needs to be considered. Equity is generally a longer term funding source than debt, and it may therefore suit some business owners who have longer term growth and investment plans for their business. Asset profile. Businesses with less robust tangible asset bases lend themselves far more to raising equity than for debt. And similarly, businesses with lumpy, less predictable cash flows will also lend themselves more to raising equity than debt. Equity in terms of repayment flexibility is slightly better than debt, in that equity-related payments are invariably more flexible in terms of dividends being withheld if needed, if the business needs to retain the cash, whereas interest in capital on debt invariably can't be withheld from a lender without breaching financial covenants. Also, operational and strategic support. Some owners of businesses welcome the expertise that an external, highly experienced equity investor can bring to their business over and above the pure funding that they inject. However, of course, control is a key issue. Equity investors will want to protect their investment, and they will do this by the use of various mechanisms such as enhanced voting rights, ratchets, good and bad lever rules, drag and tag along provisions, and high-level operational restrictions. So if current owners want to retain total control of the business, then equity is not going to be the right route to take. So that's an overview of some of the key considerations when looking to raise equity funding and deciding whether you think equity funding is something that you wish to pursue. But also things that you need to be thinking about are what else can equity investor offer you apart from simply putting money into your business. And here are some key considerations that you might want to consider. Firstly, what strategic and operational support can they provide to your business and to yourself, and at what cost? Also, what access do they have to a wider network of contacts in your existing and or target markets? Similarly, what access do they have to outside personnel who may be able to supplement your incumbent management team, strengthen that team? What channels exist to meet with their other portfolio companies so that you might be able to tap into sales opportunities and also share best practice with those businesses? What further funding do they have available for future M&A and other growth requirements, such as working capital, capital equipment, new premises, etc.? And also, as said, what is their ideal exit timetable so that you're aligned from the outset with them? If you get that far and you get a deal agreed with a preferred equity investor, then due diligence and detailed transaction documentation will follow. But for the purposes of this webinar, what I'm going to do now is move on to discuss the Future Fund. So the Future Fund was introduced in April by the Chancellor. It's a 250 million convertibles loan fund. The scheme is open until the end of September 2020 and will be delivered in partnership with the British Business Bank. The fund does appear to be more generous than some similar schemes that have been introduced in France and in Germany. The loans will be a suitable option for business owners who are receptive to third-party equity investment, having considered some of the things I've just spoken about, and or whose businesses may be unable to access the various debt facility schemes that Greg has already spoken about. Some of the small print around the Future Fund is convoluted, but the headline terms for these convertible loans are as follows. Firstly, eligibility. To be eligible for a loan under this scheme, a business must first of all be an unlisted UK registered company. It must also have raised at least 250,000 in aggregate from private third-party investors in previous funding rounds in the last 5 years, and it must have a substantive economic presence in the UK. So you must meet those criteria to be able to apply for the future fund. The government shall then make unsecured funding available alongside other third-party matched investors. So this means that the government loan shall constitute no more than 50% of the aggregate funding being provided to your company. The minimum and maximum amounts that will be provided by the government to your company shall be between 125 and £5 million respectively. There's no cap on the amount that the matched investors may loan to the company. In terms of the use of the proceeds, quite specific, the funding must be used solely for working capital purposes. It shall not be used by the company to repay any borrowings, make dividend payments to shareholders or bonus payments to staff or management, or to settle any external fees due to consultants. The government shall receive a minimum default return of 8% per annum, which will be paid on the maturity of the loan, and loans shall mature after a maximum of 36 months. In terms of the conversion of the loan into equity, some of the terminology and terms and conditions is quite complicated. Effectively, the funding shall automatically convert into equity on the company's next qualifying funding round. On a non-qualifying funding round, the funding shall convert into equity at the election of a majority of the matched investors. A qualifying funding round shall take place where the company raises an amount in equity capital that is equal to at least the aggregate amount of the funding, and effectively a non-qualifying funding round is everything that doesn't meet that criteria. On a sale of the business or on a float, an IPO, the funding shall either convert into equity or it shall be repaid with a redemption premium, whichever is the higher amount. If the loan matures after the 36 months, then it shall, at the option of a majority of the matched investors, either be repaid by the company with a redemption premium, or it will convert into equity, unless the government requests payment in respect of the loan. Conversion into equity. On a conversion event, the loan shall convert into the most senior class of shares in the company. And then in terms of day-to-day, once the loan has been made or the loans have converted into equity, the government shall have limited corporate governance rights during the term of the loan and subsequently as a shareholder following conversion into equity. The company's owners shall provide limited warranties to the government, including in respect of title and ownership of the shares, the company's loan eligibility at the outset, adherence to the company's borrowing facilities, and also litigation and insolvency events on closing of the loan. So quite normal sort of overhead warranty information needed. In terms of covenants, the company shall provide limited covenants to the government, including undertaking to treat the government fairly and equally and to provide the government with the same information rights as other investors in the company. In terms of raising other loans while the future funding is in place, the company shall not permit the creation of any indebtedness that is senior to the government loan other than bona fide senior indebtedness from a third party that is not an existing shareholder or matched investor. Government will also have the right to transfer the loans either to institutional investors or within other government departments. So that's an overview of the future fund and also giving you some considerations of equity investment. In terms of next steps, you'd need to put together an investment document. This document effectively sells the business to investors and lays out realistic plans and objectives for the business moving forward. There are a number of key things to include in such a document, and we'll be happy to discuss this further with anyone offline who wants to discuss equity funding in any further detail. So that's the end of my summary of equity finance considerations. It is a hot and quite topical at the moment. And I've also given you a run through of the details of the future fund. So thank you for your time. I'll now hand over to Jay to discuss R&D reliefs.
Thank you, Laurence. Good afternoon, all. If you joined us for the previous webinar, we were looking at the interaction of coronavirus business support schemes with the R&D reliefs that the government has. For the purposes of this webinar, I'll do a very, very quick refresh just for people who might not even be familiar with R&D schemes, and then look at that interaction again. And then we'll be looking at where the schemes are going in terms of the government leading an innovation-based economy. The schemes are going to be quite central to providing that mechanism for rewarding innovation, essentially. So just to start off, all developed countries around the world have such incentive schemes. Basically, it's how developed economies incentivize companies to do real R&D work. When I mean by R&D work, it's problem-solving work that's quite difficult. It's very involved. Big macroeconomic studies have shown that for every sort of pound of development work, there's almost a 3-pound ripple effect in the wider economy. And that's why governments are very keen on attracting businesses to do that work here. And hence they reward those businesses for doing that work, because essentially in the future, it results in growth, and that resultant growth results in essentially ends up in higher tax revenues for the country. So this is the sort of thinking behind it. The UK R&D tax incentive schemes are essentially divided into two. You have one dealing with retrospective claims, and the other dealing with basically how much revenue your IP generates. We'll mainly be talking about the former. So R&D tax reliefs will celebrate their 20th anniversary this year. The government are looking to maintain or increase targets for innovation funding. In the previous industrial strategy document, which was released last year, which might be superseded by a more updated one later on this year, but the headline figure is currently the UK spends about 1.3% of its GDP on R&D activities. The aim is to get this up to 2.4% GDP, where you have very high tech economies such as South Korea performing in that kind of space, and that's where the government likes to be. Now, R&D tax reliefs are the most popular schemes to. And the reason that is because they help with cash flow. These schemes are tied into the UK charge for corporation tax. So the schemes essentially look at the scope of the scheme. Essentially looks at 24 months before your latest year end. So if you've had a year end if you have a year end in July, for example, the deadline to claim for your period ended July 2018 would be July this year. Now, the key for an R&D claim is, because they're retrospective, you're looking at what activities you did in those years and what costs you incurred as a result of it. So what you're looking at is, let's remove R&D from our minds for a minute and replace it with problem solving, and specific problem solving dealing with technology or engineering or logistics, etc. So what we're looking at is, where has your team come across problems where they've had to take a step back and think about it and have discussions with each other, and possibly even arguments with each other over what does work, what doesn't work. The assumption being made here is, of course, that your team is working at the leading edge of their field, meaning your technical professionals are not beginners and getting trained up. These are people that have experience and knowledge of what is possible within the field. And when your team encounters, or rather encountered these challenges in the past, then essentially they'll be having these discussions, as I mentioned earlier. Some of these discussions might morph into modeling. Modeling is a fancy way of saying, well, they might be using tools to predict what these complex systems are behaving like. So for example, if I'm in the food industry, maybe suddenly I've realized that people are really into gluten-free foods. Okay, maybe I have a spreadsheet that models the cost of gluten-free food, invoking gluten-free ingredients and with modern recipes. And I inform that spreadsheet with my experience of temperatures, cooking times, things like that. So it basically, when I'm talking about modeling, it's about codifying something. It's not just food related. The R&D claims are very wide ranging. They've been purposely made so to include pretty much all types of industries, ranging from software, as I mentioned, food earlier, to construction, engineering, to gardening. And then the last form of problem-solving activities can manifest as trials. So after discussions, might morph into modeling, spreadsheets, or maybe more advanced engineering tools like SolidWorks or AutoCAD. And then you can move into trials or experimentation. So that's where your team has undertaken the risk of, well, we don't know how this system behaves. We don't know, for example, if you're in construction, we don't know how the structure interacts with this type of soil. So let's run a trial. And again, that is a form of problem solving. So the key headline is that your team should have been conducting work to overcome these technological challenges, and that these challenges were not trivial. It required a lot of thought. When we look back in your history and we're talking about various problem-solving activities that you're doing, there are a couple of methodologies of how to do this. If you're a big multi-billion-dollar company, HMRC expects that you should have a proper project management software where your staff time and your other costs like subcontractors, utilities, etc., are all written to a project code, such that when you come to examining what was R&D and what wasn't, you can filter that through and bring it through. If you're a smaller company, HMRC accepts that you don't have a very formal project management system, so they can accept a top-down methodology, which is maybe just looking at a list of your staff, looking at what you paid them in the year, and then assigning R&D percentages to them. So how the scheme works is we look at the technical challenges, structure them, pick out the major projects. You don't need to pick out each and every one, just the key ones, and then pick out the costs, and then come up with the methodology that HMRC calls is fair and reasonable, such that you can apply that to the costs. So in the R&D tax relief schemes, you have two types of sub categories that run in there. The first one being the SME scheme, which is the more rewarding one. So once I capture the challenge, the project, I filter down, I capture the cost, whether it's staff time or payment to a subcontractor or payment for a prototype, whatever it was, and multiply an R&D percentage that's representative of how long that challenge lasted, I come up with an R&D cost. For every £1 of R&D cost identified in the SME scheme, it rewards profitable companies up to 25p back. For loss-making companies, it's up to 33p back. So this is where the reward comes in for cash flow, because you might not have thought that you do R&D, and when we look back 2 years, we can make claims for you and essentially get you either a refund on your corporation tax. If you were loss making, the scheme enhances your losses and you can surrender that for cash. So very, very popular for SMEs. If you're a large company, for R&D purposes, that's if you have more than 500 full-time employees, more than 100 million euros of turnover, or more than 86 million euros on the balance sheet in assets at a group level, then for the large company scheme, you're rewarded 10p on the pound instead of 25p or 33p in the SME scheme. So that's a straightaway tax credit. So for every pound, you get 10p back, and essentially that shows up above the line. So it is a tax deductible credit. And HMRC recently increased the credit rate from, I think it was 12% last year, and now it's increased to 13%. But after tax, the equivalent benefit rate is about 10 to 11p. But I just go with 10p as a conservative measure. Now, that's basically your crash course on R&D claims. Now, the thing is, because the SME scheme is so valuable and so rewarding, it's classified as state aid by the EU. Now, usually that is not a problem unless you have grants or other forms of state aid that have come in to subsidize your work as well. Now, this is very important to consider, especially if you've undertaken CBLIS or bounce back loans, because for the purposes of R&D, these are classified as state aid. The World Trade rules say that you can't have two forms of state aid subsidizing the same piece of work. So, for example, if I undertook a bounce back loan recently, and I tried to do a claim for this claim period, if that bounce back loan has subsidized my staff salaries or payments to subcontractors, anything that was contributing towards R&D activities, then you have to take that entire project and put it into the less generous large company scheme. So instead of getting 25p on the pound, you're getting 10p on the pound for that project. The absolute worst case scenario that we've seen is people accepting CBLIS or bounce back loans or even government grants and saying, oh, we just used it generally for all our projects. Well, what that means is all your projects now have to be funneled through the less generous scheme. If you have undertaken bounce back loans or CBLIS, it's not a problem. All you have to do is be very careful and keep a somewhat of a record or a schedule and show that you funneled very specific work with it, and the rest of the work will be protected from it as well. Now, that's your rundown on what R&D claims are, how they're structured, and their brief interaction with the other coronavirus business support schemes. In terms of getting back to business, because R&D claims are very valuable and they're a headline figure for cash flow for a lot of companies, especially startups, the good news is that HMRC have maintained their standards of processing claims despite the lockdown. So HMRC is still sticking to processing 95% of submissions within 28 days. And that's both for the SME and the large company claims, which is quite good compared to last year, where HMRC had quite a backlog and they were taking about 3 months to process claims. The other thing to keep in mind is, remember, if you've undertaken furloughing of your staff in the current period, and when it comes to your end of period, let's say you have an end of period in December, and next year you come about to doing your claim, be careful of how you take that apportionment of time of your staff, because we've seen traditionally startups claim quite a high percentage of this staff time. So they could claim up to 90%, which is fine if it's justified and it's provable that that staff member was working on resolving those challenges. But if you furloughed that staff member for 3 months out of the 12, and then in the R&D claim, you're trying to claim for 90% of their time, clearly that's a conflict. So you have to be careful. You have to make sure that you're not compromising yourself by showing that, you've just tried to put a number into an R&D claim. You have to put some thought behind it. If you have furloughed staff for 3 months, then that means the maximum that you can claim for R&D time is the 9 months out of 12. So care has to be applied. HMRC has increased the level of scrutiny in claims, especially in software. It's not to scaremonger, it's just to make sure that as taxpayers, we subsidize the scheme. HMRC wants people not to take advantage of it. So they have, software has been one area where there's a lot of ambiguity. You know, what the key test is, are you the one undertaking the risk to make it possible? You know, so you haven't just handed the work over to a third party to do on your behalf. You should have undertaken the risk of resolving technical challenges. And in sort of talking about where R&D claims are headed, you know, there are big sort of discussions going on in circles of, well, because of the massive amount of support the government have given, you know, are they going to look back to scaling the R&D claim support back? The answer, I think, is a resounding no from what's coming in from government, is because if they do that, companies will simply realign themselves to do their development work abroad. So they'll be kind of shooting themselves in the foot there, especially when the government is coming out with a message of, we want to come out of the lockdown with the green economy. We want to come out with an innovative economy. The reason why they're leading with these messages is because obviously the UK has a target of becoming carbon neutral by 2050. Whether that's achievable or not is another question, but you know, they certainly want to try and get there as much as possible. So, you know, the R&D scheme has turned out to be the most useful mechanism to reward companies. Now, because we had certain companies in the past that took advantage of SME claims when they shouldn't have. Sorry, I will conclude quickly. I think I've run over. HMRC was looking at bringing in a cash credit limitation based on the amount of staff that you have. They've suspended that until further consultation next year. We'll keep you updated on what HMRC eventually decides. And now I'd like to pass you over to Patrick King, who will cover IHS and other tax matters. Thank you so much.
Yes, good afternoon all. Thanks, Jay. As a bit of light relief, I guess, from some of the COVID-19 related matters you have been hearing about, I thought I'd like to speak to you just fairly briefly about inheritance tax primarily, but capital taxes in general. And the main reason for this is that there are one or two opportunities, perhaps. It's fairly rare to see an opportunity or a good thing come out of COVID-19, but perhaps there is an opportunity as a result of some of the effects of COVID-19 in the areas of inheritance tax. Now, unlike everyone else, I'm going to try and use some slides. So with apologies if this goes horribly wrong, I shall share my screen and endeavour to show you a presentation, which hopefully you've now got. I'm sure one of my colleagues will tell me if this isn't working. Inheritance tax paying is primarily what I wanted to talk about, and I should be fairly brief.
I'm not sure I can see it, Patrick, sorry.
You can't see that?
I can't see it either, Patrick. It's Laurence.
Sorry.
Let's try again then. Right, so share. Can you see that?
Yeah, that's spot on. Thank you.
That was my own incompetence. Apologies for that. Here we go. Right, so what is inheritance tax? Now, some of you may already be aware of it, but just very quickly. Basically, inheritance tax is a tax on the value of your assets when you die, and sometimes during life when you make gifts. The tax rate is quite nasty. It's 40%. So if you are taxable on your death estate, it's 40%. That's the end of it. Where you have lifetime gifts that are taxable, they're at a lower rate, 20%, which is not so bad. but it can still become 40% if you die soon enough. And apologies for talking about dying at this time, but that's kind of goes with the territory with inheritance tax. Now, on the good side, everyone has a nil rate band of £325,000, and to the extent your estate is less than that, the tax rate, as the name suggests, is nil, hence nil rate band. And so under 325, you don't have to worry about it. And some people may have an extra band called the residence nil rate band, which is another £175,000, which gives them £500,000, and a married couple £1 million, which was something you may remember George Osborne talking about some years ago. So that's the magic £1 million. Unfortunately, the £175,000 extra relief disappears for estates worth more than a couple of million, broadly. So it's only available in very small numbers of people. Now, there are lots of reliefs from inheritance tax, and I'll touch on some of those in a moment. But one of them that is perhaps not immediately apparent is capital gains tax. The reason I mention capital gains tax is that when you die with assets in your estate, maybe second homes, maybe share portfolios, they will have probably got quite a lot of capital gain inherent in them. And if you'd sold them during life, that would have resulted in capital gains tax. When you die, however, capital gains are wiped out. Your beneficiaries receive the asset at the value at the date of your death. But of course, your estate may have to pay 40% inheritance tax. So it's about balancing these two that we have to move forward. So some of the gift exemptions first. The first one, probably the main one, is the 7-year rule, otherwise known as potentially exempt transfer rule, whereby individuals can give away pretty much anything they like. There's no limit on this, provided they survive for 7 years. It's exempt from inheritance tax. So that is a get out of jail free card for many people with surplus assets to just give them away, survive 7 years and no tax. But of course, it doesn't help a lot of people whose estates aren't big enough to allow them to give significant amounts away. So that's the first thing. The second thing is there is a small annual gifts exemption, £3,000 a year. That's not very much, but you can take advantage of it. Gifts to charities and political parties are free of tax, and there's no limit on those either. So if you wanted to give the Tory party £1 million to celebrate what a good job they're doing, you can do that. There's no inheritance tax on that. Regular gifts from surplus income are often overlooked, and I'll mention a little bit more about that in a second. Gifts into trust are usually chargeable to inheritance tax, but trusts can be very useful. There's not enough time today to go into any detail, but trusts can be useful in inheritance tax planning. Moving on, so gifts out of income. I mentioned this is very valuable. Basically, if you have income above and beyond your normal everyday needs, you can give that away as long as it's part of a series of gifts. It's a normal gift out of income, the way the rules work. And that is immediately exempt from inheritance tax. And I've had clients give away six-figure sums in this way, immediately outside their estates, immediately exempt from inheritance tax. So it can be very valuable. It does depend on having surplus income. But I'll put at the bottom there, what about gifts into a pension fund for grandchildren? Now, a lot of people may well have enough to be able to give away £2,000 or £3,000 a year. So think about it. If you have a new grandchild, you could put in up to £2,800 roughly pounds per year into a pension scheme for that child, and that's about the limit of what you can do for a gift to someone for a pension benefit. If you did that for the first 18 years of their life, so you've got 18 times £2,800, it's not a huge amount of money going out of you, immediately exempt from inheritance tax. By the time that child reached 65, on a very modest growth idea for the pension fund, they could well have a pension fund of over £1 million. So that's not something you immediately think of, but you could set a child up for his retirement in many years' time from the age of 18 by doing that and use this relief to do so. Other reliefs. Business property relief is what a lot of our clients rely on to mitigate their inheritance tax. A lot of their value is often in their business, whether it's the company they run, whether it's a partnership or a sole trade. Potentially they have reliefs of up to 100%, and you can see the different reliefs there on the slide. As long as you've owned that business property for more than 2 years, that relief will apply. And so that can make a huge difference to how much inheritance tax someone with business property pays. And there's a similar relief for farmers, basically, called agricultural property relief, which gives you the similar sort of relief for agricultural property and buildings. Why have I mentioned those and why am I talking today? Well, I mentioned an advantage brought about by COVID-19 perhaps, but on the flip side of that, the other reason I wanted to raise this issue to your attention is there has been quite a lot of reform proposals in recent times, very recent times, relating to inheritance tax. And the two key reports are shown there on that slide. The Office of Tax Simplification Inheritance Tax Review as their second report, and the All Party Parliamentary Group on Inheritance Tax and Intergenerational Fairness, a catchy title if ever I heard one, which was also released last year. So let's just quickly look at those. Perhaps you'll see why I'm bringing it to your attention. The OTS second report is relatively easy to bear, and the changes it suggests perhaps aren't as bad as the next one will be, as you'll see in a minute. But nevertheless, it does warrant some attention. I mentioned the 7-year rule, so you can give away as much as you like, survive 7 years and pay nothing. On the good side, the OTS suggests reducing that 7-year period to 5 years, which sounds good. But on the bad side, they're abolishing a taper relief which applies in that 7-year rule, which I didn't talk about before. The 7-year rule, as it stands at the moment, allows some relief from inheritance tax, provided you survive for at least 3 years. And you get a sliding scale, steadily increasing the relief until you reach 7 years. The OTS suggests abolishing that relief completely, so you'll need to survive 5 years to get anything at all. But it's only 5 years, so some good, some bad. Not so good, they're looking at doing away with most of the other exemptions for gifts, so small gifts, gifts of income, etc. And giving you a set personal gifts allowance, which no doubt won't be a particularly large number. So the ability to give away 6-figure sums from gifts out of income, for instance, might well go if they follow these rules. The other big change they're suggesting is that the automatic uplift in base value for capital gains tax purposes, I mentioned before, will probably go under this idea where there is an inheritance tax relief available. So for instance, if you passed on your business to the next generation, business property relief would reduce your tax year of inheritance tax purposes, but the gain would no longer be wiped out and instead would be passed on, and your beneficiaries would decide that something you wouldn't have told it. They're also talking about reducing the scope of business and agricultural property reliefs, so they expect that relief to get trimmed. If we move on to the All Party Parliamentary Group report, that is a lot more radical. Here, in essence, they're throwing away the whole of inheritance tax and replacing it with, on the good side, a flat rate of perhaps 10%. This is what they suggest, 10%. Now, 10% sounds very good as a rate compared to 40%. On the not so good side, though, all the reliefs that I've mentioned, and quite a few others that I haven't mentioned, will be abolished. So there will be no potentially exempt transfers, there'll be no business property relief, no agricultural property relief, no gifts out of income. Instead, you'll have an annual gifts exemption, they suggest, of £30,000. So you'll be able to give away that much each year. Any more will be taxable. And when you die, or on any gifts above that, there'll be a 10% tax rate. Now, for a lot of people, 90% of the population, it really makes no difference. And for some, it might even make things better. But for those of us, and particularly our clients, and especially where you have business property that's quite valuable or farm property that's quite valuable, this could be quite nasty. And the ability to plan, which is currently there, the ability to make potentially exempt transfers, gifts out of income, these will all go. So that's one of the reasons that I wanted to raise this today, to sort of emphasise that now is probably a good time to review these areas with a view to seeing if you can accelerate and take advantage of these rules while they're still here. Now, I also said that it's a good time to plan because of COVID-19, which is a strange thing to say, but if you think about it, values right now are probably lower than they have been for some considerable time. Depending on the economic impacts going forward, they may go lower, but the reality is right now, the value of a lot of your assets will be lower than it was last year. If the values of assets are lower, it's easier to give them away with less of a capital gains tax problem and possibly less of an inheritance tax problem. So I think for those two reasons, the reduction in value brought about by the virus and the threat of an increase in tax effectively by those two reports, it gives you a very good reason to think about looking at your inheritance tax position now, or at least soon, and perhaps taking some action. Now, we at McIntyre Hudson, as you might expect, will assist with this if you'd like us to, and we'll offer a health check, if you like, in your inheritance tax affairs for a fixed fee, which we'll discuss with you, not a huge amount of money, to review your estate, calculate your inheritance tax position, and look at identifying some inheritance tax planning opportunities there may be. So please give us a call. You can contact me, or you can contact your local tax partner at McIntyre Hudson to have a look at this with you if you'd like to, and we will see if we can assist. That is the end of the slides, so let me just stop the sharing. There we go, and I'm going to hand over now to Alison Horner to talk about VAT and then, I believe, Brexit. So thank you very much.
Thanks, Patrick. Hi, everybody. I'm going to talk to you about pay-as-you-earn deferrals and VAT deferrals. First of all, pay-as-you-earn, you can only ever defer for 3 months, and I can't believe that 3 months has just whizzed by. I spoke to the COVID team myself today, so it echoes very much what Nigel and Greg were saying, that it's not the free-for-all that it was 3 months ago. HMRC have a very different approach now, and for pay-as-you-earn, they will only agree to 3 months, and more importantly, and probably a point that I haven't really put 2 and 2 together, but you need to pay over the pay-as-you-earn and national insurance for all the furlough payments that you've received, and do it as soon as possible. They're cracking down on that, and I was told today that if they're not paid over, then it can restrict you getting approval for furlough going forward. So I think that's a really important point to take away. Also, with pay-as-you-earn deferrals, you get charged interest at 2.6% on amounts that are still accruing. So I think the strategy for pay-as-you-earn deferrals is keep in close contact with HMRC and have a strategy to pay those as soon as you can, particularly with that furlough point in mind. On the VAT side, we all know that there's been an automatic deferral, although again, I do think that it is well worth keeping in close contact with HMRC, getting those notes on your electronic folder and speaking to them. So that VAT deferral, again, it covered certain VAT periods, but it does not cover the VAT return period, which is to the end of May. So if you're on a May return, and you're maybe a little bit confused because you think, well, I've got to pay it sort of by June, you're still not covered, unfortunately, because the due date for payment is the 7th of July. So please make sure that your VAT return for May is submitted and paid in full. And if you're on a direct debit and you've cancelled it, make sure that that's reinstated. So those are the 2 deferrals. What if you're in a position where you can't pay them, or you're going to need some extra help from HMRC? We're then straying into the realms of time to pay agreements. And if you are going to be considering entering this, I think you need to be really prepared for it. First of all, it covers all taxes. So again, strategically think, do I need to do that now, or can I wait until later? Can I maybe get to the end of that VAT deferral period, which is the 31st of March 2021, and maybe if I'm going to do a time to pay, if I can get that far, is it that I maybe then need to think about speaking to HMRC about? You really don't want to go too early, because traditionally you only have 1 attempt in a year to agree a time to pay arrangement with them. And remember, it covers all taxes, pay-as-you-earn, corporation tax and VAT. So look at it in the round. Be aware that if you go for a time to pay agreement, you need to give them a lot of detail about cash flow, about loans, about what's in your bank, whether you can get overdrafts, etc. So it is not the simple, helpful approach that we've had when COVID first hit us. HMRC are now really knuckling down on, they want their money back in the coffers, which is to be understood. And talking about the Treasury and tax and money in the coffers, moving on to what was rumoured to be an emergency budget in July, which has now been downgraded to a moment, which sounds like a chocolate to me, but anyway. There's been rumours of a VAT rate cut happening in July, although it's been said that there won't be any legislation drafted as a result of this announcement, which kind of, in my mind, puts it back to more like October time, when again there's another rumour that we'll have a full budget then. When we had the last VAT rate cut back in 2008-9, it actually was subsequently found that it didn't really stimulate the economy, and what it did do was cause an enormous headache for a lot of businesses in trying to cope with bringing that in. So hopefully that is in the government's mind if they're considering a VAT rate cut. Having said that, obviously it's a hugely popular thing to do, and certainly Germany have just announced that they have cut their VAT rate for a certain period. So moving on to my final point, which is about Brexit. Sorry to mention it. Talking about the new normal, we have to accept that we are now not having an extension to that transitional period. So that transitional period where we just use normal VAT and customs rules for intra-EU trade until the end of December 2020, we won't have an extension to that going forward. As far as imports into the UK are concerned, Michael Gove has announced that he will bring in simplified declarations, which will be in place until July 21, which has been really gratefully received. And it's pretty much like the simplified transitional arrangements that we kept hearing about each time we were going to be hitting Brexit over the past 2 times. So that's useful, and it involves things like import VAT. You won't pay it to clear your goods. You will do it on your VAT return under postponed import VAT accounting. Also, you won't have to make declarations in full until 6 months down the line. Obviously, this only applies to things coming into the UK. If you have customers in mainland Europe, you need to be thinking that it doesn't apply there. You will have to do the full declarations. You need to be really getting to grips with, if you haven't already, what your customs duty rates might be. You can look, we've got a Brexit update which is on our website at the moment, or if you need to speak to me, please just drop me an email. I'll be happy to send that to you or discuss it with you. But for imports into Europe, you need to be thinking, where am I importing them? What are my Incoterms? The headline there is, if it's delivered duty paid because you deliver it to your customer's door, you might have a liability to register for that in that country. Also, you may have a liability in a lot of countries to appoint a fiscal representative. So there are a lot of expensive type problems there that you need to really understand and plan for. And finally, our Brexit update looks at things like international trade, getting to grips with it, understanding the new UK global tariff, understanding the World Trade Organization tariffs into Europe, understanding things like inward processing relief, authorised economic operators, how to do a declaration, how to get a custom duty deferment account, all of those sorts of things which are far too detailed and horrific to discuss with you today. So thank you for listening, and thank you in particular. I would just particularly say pay-as-you-earn deferrals. There's a few little nasties there, and I really would urge you to have a look at that and make sure that you're not going to trip over on it. And on that note, I'll hand you back to Nigel. Thanks.
Thank you. Thanks to all our presenters. That was all extremely useful and informative stuff. And I appreciate we've gone slightly over the hour, but I think it was important. There was a lot there to think about in terms of where we are now, doing the right things, preserving what we have done, utilising it the best way we can. Whether that's the CJRS scheme, use it, but do it properly. Whether that's the funding, maximise it, make sure that you're doing the right things, and think about the top-up type arrangements. Also, in terms of what's the right type of funding for your organisation to help you through the recovery phase, which could be quite extended. Some of those planning pieces, whether that's R&D, and think about the interaction with furlough scheme and loans, so that you get the right pence in the pound. Very, very important. Cash is still going to be key for a very long time. obviously think about the opportunities. Clearly, you know, as Patrick outlined, whilst there may be some downward pressure on valuations, that could be really helpful to you in terms of sort of tax planning. So don't just think about the today. Think about, you know, what tax you might be paying, or how you could mitigate that appropriately over the sort of next year or more. And some really useful stuff from Alison there in terms of, yes, a reminder. I've had a client who had a little reminder letter saying, thank you very much for putting your furlough claim in. By the way, we don't appear to have had the national insurance from you. And obviously, because that is still due in relation to the furlough claim, because government have given you that money. But of course, you've got the rest of your PAYE that you may have deferred. Make sure that you've done that properly, and then balance all of the tax deferrals, all of the support that you've had that best supports the business, particularly as there'll be pressure to, as Alison said, to recover some of those monies and charge interest. So quite a few things there to think about. But you know, hopefully that was very, very useful, and I certainly enjoyed it. Thank you, everybody. Look out for the updates on our website and for our next session in a few weeks' time. Thank you. Bye now.